Cardinal Stone Securities has released their 2022 mid-year outlook for Nigeria. It's titled Same Challenges, New Shocks, and features, a human jumping across uneven terrain. The metaphor is quite clear. Joining us to discuss the report, Philip Anegbe, Head of Research at Cardinal Stone Securities. Philip, you're very welcome. Good morning to you. It's focused on Nigeria, but there is a global, you have a global outlook there. Why don't we start with that from the report? There's a whole bunch of charts. Is a global recession on the cards? I have to start with that, and let's put up all these fantastic charts from your report. What do you think?
Yeah, thank you very much to you and your team for having us on the show. We think that the recession fears are very much upon us. They are true. They are real. We've seen some economies actually contract in Q1. And these fears have been driven by the increased tightening that we are seeing globally to arrest the inflation that was made worse by the invasion of Ukraine. So commodity prices are rooftops. Inflation very elevated for some countries in excess of 40-year highs, right? So that's more or less reduced the pace of pass-through from nominal growth in these economies. And those are problems that have affected countries like the US, right? They contracted in Q1, Japan contracted in Q1, Britain grew at its slowest pace in 1 year in Q1. China grew better than expected, but then there are fears because of the emergence of COVID and the spread. And then there are problems in the property market. So you can go on and on. So the recession fears are real in our view.
Wow. What about what this means for emerging markets? Or what's the main fear capital flow? In fact, I think we should put this up. You have there's 18 billion, I think your report says, that has flowed. Is it from emerging markets over to developed markets? What's the main risk there?
Yeah, for emerging markets, we like to view it from two lenses.
Yeah.
Right. The first lens is whether, of course, the country is a net commodity exporter. I would like to say proactive net commodity exporter that has ensured that the structural encumbrances within its economy has been arrested to put themselves in better position to actually take advantage of higher commodity prices when they occur. Right, those countries are likely to do better. But then you have net commodity importers that are likely to suffer from higher commodity prices. They import inflation from abroad as a result of higher commodity prices. But on the whole, what we've seen is that there's been a flow of funds from these markets to markets considered to be safer haven, right? So you look at flows from net outflows. There have been net outflows from fixed income securities, from equities in this market, right? You look at the JP Morgan Emerging Market Bond Index, it was down by about 15% in H1. So it tells you what you need to know. So there's a lot of risk sensitivities intensified, right?
Yeah, and it's there it is. And we can see from the left, down the chart there, from January 2021 all through May, you can see the downward trend as far as that's concerned. I want to ask you, I think we have another chart here on elevated levels of debt distress for sub-Saharan Africa. You've got Ghana, Tunisia, Kenya, all in talks with the IMF over fiscal assistance. So yeah, okay, there's the chart there. So how it looks very elevated.
Very elevated, Roches. And it's interesting because according to the IMF, about 50% of sub-Saharan African countries are in debt distress or at high risk of same.
Yeah.
Now, when you compare that proportion to what we had in 2015, you see that it has risen by almost 27 percentage points.
Wow.
And that picture becomes worse when you consider the fact that the cost of borrowing is actually increasing globally. And so is the cost of servicing these debts. So there's a lot of problems servicing these debts. The debts keep rising, but then there's a lot of problems servicing these debts. And for most of those countries, their savings culture is not so robust. And then the capital markets are not so developed. So they still have to make recourse to foreign borrowings in expensive markets. So really interesting development and seriously concerning.
What did you make of the MPC outcome to hike in Nigeria? And I guess inflation fears, what's your read as far as we are concerned?
Well, the MPC decision was largely expected, right? According to global developments, we've seen reactions to rate hikes. So it was more or less expected, right? We quote and unquote, they joined the hawkish parade in the previous meeting before this one by hiking rates by 150 basis points. Now there's a further 100 basis point increase in rates. And the argument is to arrest demand-side triggers of inflation, even though it acknowledged that Nigerian inflation is principally supply-side driven, right? Calling on the government to put structures in place to address those supply-side factors, right? But on its own side, trying to make sure that excess liquidity don't go around to more or less fan the flames of inflation. So it's expected. So expectation is that you continue to see yields actually track those decisions, those hawkish decisions going forward.
Just to follow up on this, and okay, so we have that up there showing how they've turned hawkish. If you express language that you are chasing after inflation, do you again fall into the trap of every time inflation goes up, you now have to hike? Are we now on a hiking spree? What do you think is good? Like for instance, okay, what 18.6% food inflation, 20%. That's for June. If we get to August and July, I don't know, maybe 50 basis points, inflation goes to 19% or something. Does that then put the pressure on the MPC to hike again?
Ordinarily, there is positive relationship between inflation and rates, right? Inflation going up, you want to raise rate to arrest that. But because in Nigeria, it's not just a question of demand side, there are also supply side factors. So the expectation is that once those supply side factors are checked, right, the pace of inflation increases will moderate, and that may more or less slow the pace of hawkishness for the CBN, right? So the expectation is that it will come at a time, right, when supply-side structures are put in place or some of the short-term challenges are addressed that will moderate the pace of inflation, particularly food inflation, right? And when that happens, you may see the CBN more or less taper its current hawkish rendition. So it may, the rate adjustments or the tightening that we are seeing may begin to slow when that happens.
All right. I like the fact that brokerage services in Nigeria are talking about the impact of the election and what it means, not just for markets. You have a section here where you talk about electioneering and what's its impact, I guess, on the country. Is there currency pressure there in electioneering?
Well, there are several media reports on how electioneering activity is actually driving dollar demand, right? But the truth is, you have limited data to actually back that or more or less corroborate that view. In our view, the currency crisis we've been experiencing, and it's a bit legacy, if I may say, right? Because it's been on and on for several years. They are principally driven by supply-demand factors. Clearly, supply is not enough to meet the demand, supply of FX. We've over the years depended heavily on the CBN as more or less a very important supplier of FX in the different markets. Once they decide to halt supply in any of the market or reduce supply in any of the market, then we run into trouble. It happened in 2016 and it's happening now again. And that's why we say same challenges, new shocks. Because the shock this time, you have COVID, you have the Russia-Ukraine crisis, etc. So
that is a very appropriately titled report because it speaks to everything. There's a chart. I think the world should be expressed in charts. Frankly, personally speaking, there's a chart you have on voter turnout. Really like that chart where you show the trend there and across the numbers. Now, we should point out, I think in Osun, this most recent election, we actually saw an increase in turnout. But Philip, how do we turn this around? What needs to happen?
Voter turnout has been really, really poor in the past. But in Osun, we saw a material improvement, right? And in our view, to really sustain this improvement, you need better voter education. I think a lot of that has been happening of late, right? Better voter education. You need better security, right? You need better security to arrest fears of people being attacked while they try to express their civic rights, right? So you need better security. You also need to continuously develop electoral laws. And I must say, the recent signing of the Electoral Act has been very, very important, right? It's been very important. A number of analysts have actually credited the increase in voter participation and general optimism to the signing of that act. So developments on those in those lines are likely to continuously support voter participation. Education is also very paramount.
Indeed it is, and I'm glad the report touched on that. So what's the outlook? I mean, this is where we can now have an even more robust discussion. What do you see for the second half of the year? I guess a lot depends on who's leading the country next year, but what's the outlook, I guess, from your vantage point?
Okay, for outlook for the second half of the year, we're thinking that we are likely to see market moderation, right? When I say market moderation, we know that Nigeria was one of the best performing equities markets in H1, right? We are thinking that the country's equity market will still close in the green, but the second half may not be as good as the first half, right? And factors that are likely to impact market direction include election concerns, yield increases that we're seeing, currency-related issues, etc. Right? So in that kind of market, what you want to do is to try to have some sort of positive exposure to interest rates in the equity space by seeking to enter into banking stocks, because banking stocks tend to perform well when rates go up, because interest income will provide the needed support. Then in the fixed income space, you want to invest, you want to stay nimble. By nimble, I mean you want to invest in such a way you are able to recoup your funds to take advantage of higher rates or yields when they occur.
Okay, on the fixed income side, does the increase in inflation not discourage, I guess, the real rate of return on for fixed income securities, or will those be repriced upwards? How does that? What's the impact there?
Well, it does when you look at fixed income from the perspective of real yield, right? But when you analyze these things, it's in relative terms, right? Relative to what we had in Q1, right? The real yields were in deep negative, right? But we've seen yields continue to improve, right? So as yields continue to improve, the expectation is that the deep negative real yield will be closing up. It may not entirely close up this year, but then it's going to be markedly improved from what we saw in Q1, right? And the thing about investing is also a function of your profile, your risk profile, your return, your risk profile, right? There are some individuals, given their profile, they should have some sort of exposure to safer investments like fixed income. So those investors would still choose to invest in fixed income, even though the real yield may still remain in the negative territory, albeit it's better than what they had in Q1. So what we advise is to speak to an investment advisor so that they come up with a portfolio that will net help you to at least try to outperform inflation, at least at least so that your investment will not be eroded by inflation. Well, have equities there.
I was about to say equities are performing. Right, so is only banking? I mean, look, the reports are so in depth and there's just so much in there. But I know you did touch on stocks. So are banking stocks? And of course, as you just explained, where people should be expecting letters from their bank saying that their interest rates on whatever loans they have will be repriced upwards since the MPR has gone up. But outside of banking stocks, what other equities or what other sectors do you think look attractive?
Yeah, we think that in the short term, I must say short term here, there are potential opportunities in commodities. Commodity producers. We expect that as the results begin to trickle in for this first half, you're likely to see some excitement in the commodity producers. I think we did see that in Q1 for Presco, Okomo. That may happen again. I think more so for Presco than Okomo, because relative to our target price, we think Presco, you can see enter at relatively decent price compared to Okomo. Seplat is one. I think of recent a day or two ago, it saw good demand. So those commodity producers, they could be short-term opportunities because there was a strong rally on those names in H1, right? So you may just see bits of opportunity. But outside of those companies, we like companies that have very strong, robust balance sheets, able to actually meet their debt obligation, even in the face of higher interest rates. We like MTN in the telecom space. We like companies like Transcorp. Transcorp in the sense that of late it's been able to get most of its revenues back, so receivables are more or less coming down, so the concerns are not as much as they were before. We also, I think those are essentially the companies. So I think in the consumer space, we like Guinness and MB. Of late, it looks like they found a way to actually transfer some of the cost burden they usually feel to the populace. So they reported very decent numbers. It's expected that in Q2, the numbers will also be decent and could spur some excitement in the market.
All right. Nice to end on a positive note. Lots to look forward to. Philip Anegbe, Head of Research, Cardinal Stone Securities. Thanks for your time.
Thanks.